Course, and to get a little bit of a closer look at how the IMF's cut, both here at home and globally, is affecting debt capital markets. Mark Todd from FIIG Securities joins us now. And Mark, great to see you this afternoon. The IMF signalling out Australia as a country that will see significant growth next year. Do you think that'll see the cash rate be pushed higher at all?
Afternoon. I think there's a couple of things to point with that. The first is, when the IMF makes these statements, I'm not 100% certain how accurate they're all going to become. You know, they're so prescriptive, and you've just seen in 6 months they've slashed rates. So it's something you need to be very comfortable about in terms of how accurate they are. If you read what the IMF is saying, the impact on our economy is going to be massive. We're going to go from 1.5 to 3.6, I think they said. So from our RBA's perspective, that's a very big jump, and you'd think historically that would see that they'd lift the cash rates because inflation will be aggressive. But clearly, the global situation with both North America, Europe and England being difficult, and I'd put into that in that mix, I'd say Japan looks in an awkward position as well. So you'd see the global indecision around where cash rates should be will mean that the RBA will do everything in its power to keep the rates at 4 3/4 until it gets some more certainty around the more global macro movements.
And how are debt investors reacting to the ongoing volatility in markets in general right now?
Well, one of the things that investors don't like is this sort of volatility. So if you like, they're moving out of the equities that we're all conscious of, and they're moving more into fixed assets, fixed debt, tier 1, sub-debt, senior debt. And so if you like, they're moving out of the, let's call it the riskier asset, which is the equity piece, and they're moving up that capital structure into the more secure piece. We like to think of it as in the equity piece you're the owner, in the debt piece you're the banker, and I think most people prefer to be the banker in this environment right now rather than being an owner.
So in a way, I suppose they're just minimising their risk by spreading their portfolios out a bit. Is that the trend that you're seeing? Yeah,
I think there's we saw a lot. We've seen a lot over the last few months where people are saying a more balanced portfolios around having a lot more debt instruments, these single A's and double A credits, even the triple B's. If you're going to buy a bank, you might look at the bank debt and move up that structure and say, look, I can get, 6 to 7 to 8 and 9% returns. In a more secure environment. I think it's a smarter move, and it gives you more balance for the self-managed super funds to look at that.
And moving forward, do you think we'll see more, investment into the debt instrument market?
Oh, undoubtedly. I mean, the growth, the expansion is, it's moved out of its cyclical phase, it's into a structural phase. The issue around for the investors is longevity and volatility, and they'll be the big drivers. So the point of that is, as people are getting older, they've got less time to try and trade back out and get their money back. So they're looking at either outliving their superannuation or not being able to trade back in to get enough money for a superannuation. So they're looking at longer duration, more stable returns, and that's happened at a very structural level. So we see a lot of people promoting it, whether it be, Prime Minister Keating, whether it be the head of the future fund, Murray. We see it all the time now.
Will it be enough, do you think, to underpin a real, a cementing of the secondary market?
Oh yeah, clearly, our secondary market business has been fantastic for us. So, we're very happy with the performance, and we're starting to see new players try to get into the secondary market. There's an issue around the wholesale market absorbs an awful lot of debt instrument. It takes it at the primary level. But now, as we see people looking to move into that secondary piece where they're trying to rebalance their portfolios, there's great depth. We do a lot of business at the moment in secondary issuance.
In the primary market, what sort of returns should investors be targeting right now?
I think the idea is around that 6, 7, 8, 9% return for a sort of domestic institutions. That makes a lot of sense. And as people get more comfortable with debt, you can move up into the 9s, 10s, 11s and 12s. We can see debt, it's a broad range. It'll go 6 up to 20% returns. You could buy, theoretically, a government bond right now. It rallies, it's so liquid, it rallies 20 points. You can turn it around and make some pretty good money in those sort of instruments. If you're a debt trader, we're seeing the majority of the investors are looking for a rebalance around that volatility. So they'll be looking to buy to the end duration, buy for the term. And so I would suggest 7 through to 9 for a comfortable return.
Well, certainly a little bit better than sitting on the cash and having that in the bank. Mark Todd, FIIG Securities, appreciate your analysis today.
All right, take care.